In this video, I'm going to walk through what's known as a stock repair strategy, and we're going to talk about it on AMC. And we want to walk through exactly why someone would want to do a stock repair strategy or use this option strategy specifically, and what to look out for and how to structure it. So my name is Joshua Bellinger of CounterVest. Before we get started, make sure you like the video below, share it with a friend, and leave a comment below. So let's take a look here at AMC. Now, in one of the other videos I've discussed previously, we did a stock repair strategy trade that you could find in the comments below. And the reason why we typically look at this strategy is that an investor who has owned shares that is now underwater doesn't have the capital required to buy the dip per se. So what they want to do is they want to leverage options, and they want to create a more strategic approach than outlaying the capital that's needed for instance, on a share here that's closed at $47. So shares close at $47. Buy 100 shares, 100 times 47, you need that capital. So it's hard for investors who are limited on capital. It's hard for investors like you and I to do it because we have only so much capital. We got to make sure every dollar at risk is being maximized. So on AMC here, we're seeing this that initial pop here, got another bit of a pop, and then has faded off. Now, technical traders would say this is a rounded bottom that's starting to shift here, and that's what we're possibly setting up for. We're seeing that shift in here. It's still hard to borrow, and we could see a pop. Now, those are going to get upset at me when I say this, is that we're probably not going to see the pop that we saw back into 72. At this point, we have to take what we have visually and assume that 72 is going to be resistance. Even if you compare it to GME, which is the mega of all short squeezes per se on a pop, we had that squeeze. It squeezed all the way up to $483. You saw it pull back here, and then you got another pop up. Same formation here, that rounded bottom, but then we popped right into that resistance, is now faded off here. So the first pop is always going to be the biggest. The second one, third one are never going to be the same. That's just anything in life. But some people are going to disagree. That's fine. If you agree with my assumption or want to approach it that way, then that's what I have here for you. Okay, so taking a look here at the AMC option montage, the option chain here. I'm looking at the October. So my assumption is that over the next 38 days, we could see a pop higher. Probably going to be before that, but we're in that 38 time frame. So looking at this 38 time frame, that's where we're at. It's interesting to see the skew as well, because if we go and look at what's priced in already, the expected move, it's $21 higher or lower. Like I said, it is hard to borrow, but right now, that's what the market's priced in. And a $21 move from right now from $48 puts us right around $70. And you can see those options here are just expensive. I mean, it's just silly. And if we look at the opposite side, where we look at the 26 strike, those are trading about 74 cents. So we're almost seeing $4 of extra premium to the calls. That means the risk is on the call side, which is inverted what we typically see on equities. That's how crazy it is. And that's because the market's protecting itself and pricing in an expected gap higher or a squeeze, but making sure they get paid for that extra risk, because that is the risk that they have here as a market maker. And so what I'm looking at here is the 38 contract, and the structure that I put together here, this is what's known as a stock repair strategy, is what's known as a call ratio. It's just you're buying one, selling two. So this involves buying the 46 call and selling two of the 65s. Now, 65, to me, that's just kind of where I'm drawing the line here. You can structure this any way. You can sell the 70s if you choose. I mean, so be it, right? But right now, if we just did let's do the 70. Okay, so at these prices right here, if we did two 70s and got long the 46, roughly we're looking at about a 63-cent debit. So 63 cents, and you have profit potential from 46 all the way to 70 with risk past the 70 strike. Now, if you are thinking that this is going to just go to the moon, this is not the trade for you. If you're more realistic, this could be the trade for you. So if you're long stock, you wouldn't be short the 70 strike with the extra one, because at that point you're long call, or you're long stock and then you're short that. So it's almost a covered call. So if you bought shares, and this is ideal here to explain this a little bit more in depth here. So if you bought, let's say you bought stock back here at 57, and you rode it all the way down here and you're underwater. This is where the call repair or the stock repair strategy comes into play, because you're looking to buy into that, get paid on a push higher because you did write it down. You want to get paid on your risk, but you weren't able to add the amount of capital that's needed to buy stock that's meaningful. So that's where you add the call spread and then sell the extra call to so you don't have that margin requirement that's needed for a short call. So this would be that kind of structure here. So 70 would be my ceiling, or I would look at the 65 because it could be put on for at that time frame I just looked, it was for a credit, a little bit of a credit. So that's kind of interesting. So this could be done in two ways. It could be just a call ratio where you say, okay, I'm going to sell that extra stuff up there because it's so rich that, yes, I plan on playing it to the upside, but sure. And then if you wanted to do this, you could buy something. More strikes will probably open up in a few days, so you would want to buy something a little bit out of the money to not require that. So it's going to look a little bit different on the debit. It's going to be a little bit more expensive, but it would be almost like a trade structure on a butterfly, broken wing butterfly type. So if we just looked at this analyze tab here and just looked at it at the call ratio, analyze trade, and this is the one we want to look at. So you can see here that 70 is the max profit. And on this position right here, we're looking at about a profit on this position of just a tad over $2,000. And this is where all the profit opportunity can happen within the next month in that time frame. Now the risk, the break-even points are right here at this 46.47. And you can see here the downside risk is what you paid for that debit here. So that's the interesting part. So this is a small outlay with stock, if you have the stock, to use the covered call, a call spread, to play for that upside, to play for that pop that looks to be happening here, and to strategically not sell a call that's going to cap, it's limiting your upside, but you also have the extra kicker of the spread that you're getting in right now to help offset that. This is a trade that's, you're going to have to watch the video to go through a little bit more. But this is a way for those that may have gotten to AMC, got in the euphoria and are like, hey, look, I think this can make some money. I think I want to get out of this. How do I get out of this? And this would be a good way to be able to get out of this, if so be it, because there are people who have bought shares and are underwater. And this is a strategic way of how to get back to even, but also profit to play for this upside and not miss that, because that's the other part of trading and investing as well is, hey, I wrote all this down. It's not just about getting back to break even. I did and was caught in the excitement and that this could go higher, and I also want to get paid. So these are the ways that we manage positions, kind of work our way out of them and try to get those odds, or the assumption that we had, maybe the timing wasn't right, but our assumption, get back on the train, ride it higher, and go from there. So that's what I have here on this AMC trade here. This is what's known as a stock repair strategy. It's involving that you're already long stock. If you just do the option strategy alone, it's just a call ratio, and the reason why you sell the extra stuff up top because it's so expensive, as we just covered. So that is strategic investing at its finest. So if you like the video, make sure you like the button below and make sure you watch it a couple times. I know it's a little bit in-depth, throwing a lot at you, but this is how the everyday investor, the little guy, you and I, get better, become more strategic, and become successful in the financial markets.